Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about China Qinfa Group Limited annual report. China Qinfa Group Limited is a diversified investment holding company with various business interests. At its core, the company engages in coal-related activities such as mining, purchasing, selling, filtering, storing, and blending coal in both China and Indonesia. In addition to coal operations, China Qinfa Group Limited also provides goods transportation and logistics services, including charter hire activities. This indicates that the company has a strong presence in the transportation sector, facilitating the movement of goods across different regions. The company's portfolio extends beyond coal and transportation, as it is involved in the sale of machinery and machine materials. Furthermore, China Qinfa Group Limited offers machine repairing services, highlighting its capabilities in maintaining and upgrading equipment. Lastly, the company operates a shipping transportation business, solidifying its position in the maritime industry. With a presence in both China and Indonesia, China Qinfa Group Limited is well positioned to capitalize on regional trade opportunities. China Qinfa Group Limited maintains a market capitalization of $9 billion, broadly in line with the industry peer group. China Qinfa Group Limited trades at a higher price-to-earnings ratio of 14 times and a higher price-to-book ratio of 4.79 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 60% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. The share count has increased, while revenue and shareholder equity are declining. This indicates that management has not yet proven the business model is sustainable. This makes the investment case highly unfavorable. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline can be identified through an analysis of various factors. On the positive side, revenue growth is primarily driven by an increase in revenue from continuing operations, a significant rise in EBITDA, and substantial increases in sales of coal, particularly in the PRC, including Hong Kong, Indonesia, and Singapore markets. Additionally, improved production capacity at SDE coal mine, enhanced product quality through coal washing systems, and reduced electricity use costs have also contributed to revenue growth. Furthermore, the company's increased market competitiveness has enabled it to capture a larger share of the market, leading to higher revenues. On the other hand, revenue decline is primarily driven by a decrease in average coal selling price, which has resulted in lower revenue from external customers and intersegment revenue. The gradual depletion and increasing mining difficulty on depleting marginal reserve of the coal mines in China have also contributed to revenue decline. It is worth noting that there are some areas where no clear indication of revenue growth or decline can be identified. For instance, administrative expenses are listed as a revenue decline driver, but specific information on revenue growth drivers is not provided. Similarly, acquisitions and disposals are mentioned, but their impact on revenue is not specified. The net income of a company decreased by $140 billion, 260 million, equivalent to approximately RMB 61 million, 273,000. This decline can be attributed to several factors. One major reason is the acquisition costs incurred by the company, which had a significant impact on its financials. Furthermore, the decrease in average selling prices of thermal coal also contributed to the decline in net income. The gradual depletion and increasing mining difficulty on depleting marginal reserve of the coal mines in China further exacerbated this issue. Additionally, foreign exchange loss due to currency depreciation of IDR against RMB and USD added to the company's financial woes. The profit margins of the company also suffered as a result of these factors. The profit margin for continuing operations decreased from 29.9% to 25.7%, while that for discontinued operations dropped from 15.6% to 4.4%. These declines in profit margins are directly linked to the decrease in net income and highlight the challenges faced by the company in its operational and financial performance. The company's debt level and interest expenses have undergone significant changes in recent years. The most notable change is the substantial decrease in debt level, with a net carrying amount of nil in 2025 compared to approximately billion 378,449,000 in 2024. This represents a staggering reduction of over 99% in just 1 year. In terms of interest expenses, there has been a significant increase from 2024 to 2025. The total interest expense on financial liabilities not at fair value through profit or loss rose by 70%, from RMB 77,114,000 to RMB 130,914,000. This increase in interest expenses is likely due to the higher debt level in 2025 compared to 2024. Overall, while the company's debt level has decreased significantly, its interest expenses have increased substantially, indicating a potential shift in the company's financial strategy or market conditions. Management is emphasizing the company's growth strategy, specifically focusing on expanding its coal mining business in Indonesia. This expansion is being achieved through strategic acquisitions of stakes in various companies. Between April 2025 and December 2025, the company acquired interests in PT Trisula Energy, TSC, PT Venerasi Sejahtera Energy, VSC, PT Suprema Marulabo Energy, SME, and PT Inisiasi Merdeka Jaya, IMJ. This acquisition-driven approach is a key component of the company's strategy to enhance its presence in the Indonesian coal mining market. There are no notable acquisitions or divestitures to report. The company has chosen not to engage in any significant transactions involving the purchase or sale of assets or businesses. This decision reflects a strategic focus on internal growth and development, rather than external expansion through mergers and acquisitions. As a result, the company's financial structure and operational capabilities remain unchanged. Concerns have been raised regarding the accumulation of excess inventory and potential disruptions to supply chains. According to available data, there is a notable issue with inventory buildup, as indicated by a significant number of instances recorded on page 23. This surplus of inventory can lead to inefficiencies in production and distribution processes, ultimately affecting overall business operations. That concludes the financial summary for China Qinfa Group Limited. Feel free to comment below, and I will be happy to answer them when possible.